We continue with the next video in FRA Unit 4, and now after doing the discussion on assets, we're going to turn our attention towards the liabilities portion on the balance sheet. Liabilities will be divided into two parts, non-current and current. And we're going to start our discussion with the current liabilities first, and then take it over in terms of what do we mean by long-term or non-current liabilities. So if you look at the liabilities side of the balance sheet, we continue with our example on Tata Steel, and we find a few more complicated stuff here, especially in the long-term liabilities. So this portion here is the current liability portion. That's all my current liabilities. And all these put together are the non-current liabilities. So we'll take them one by one and try and understand them. Let's take the current liabilities first. Short-term borrowings are any bank borrowings or borrowings done from any other entity that are for a period of less than 1 year. So current liabilities, again, same definition, anything less than 1 year that has to be paid within 1 year is a current liability. Right? So short-term borrowings are borrowings which are taken from banks, let's say, for a period of less than 1 year. So these are kind of short-term loans I've taken. I just need a quick overdraft from my bank, or I need a loan for 10 days to kind of park money for some sort of an order. That comes as short-term borrowings, right? Trade payables are what I am supposed to pay to my vendors, right? What I am supposed to pay to suppliers or vendors. I've received the supply, but I'm yet to pay the money for that, and that's all going to be payables because this will be paid in the short term, right? Other current liabilities, an example of this could be accrued interest on borrowings, accrued interest on borrowings. So I have taken a loan of 1,000 crore. I'm supposed to pay the interest in next 2 months, but at this point of time, it has not come due, right? So let's say I took a loan on 1st of December of a year 2016, let's say, and I have to pay the interest 6 monthly. So the interest only comes on somewhere around 1st of June 2017. If I'm making the balance sheet on 31st March of 2017, then technically we will realize that at this point of time this payment has not happened. So that's an accrued interest component, and that will be a part of the current liabilities, other current liabilities. Then we see short-term provisions. These are provisions that you have made for items that have already been accounted as expenses, right? But have not been paid, not paid, but will be paid in less than 1 year, right? Will be paid in less than 1 year. Take an example. I could have accounted for the tax that is to be paid during the year, but may not have paid that tax by 31st of March. I might be paying the tax on the 1st of April, for example, right? I could have accounted for the dividend I'm going to give to my shareholders, but may not have paid that as yet, right? I could have declared a salary bonus to an employee, right? And not paid it. This payment might happen sometime in April end, right? So in the P&L statement, this will appear as salary because this is already announced. This is accounted for. I have to give it now, right? But I have not paid it. So on 31st of March, when we make the balance sheet as on that date, we still owe this money to the employee. We are still supposed to give this money to the employee. That's basically where it would get classified as a short-term provision, right? And we've already discussed what other current liabilities would be. Correct? Now we've turned our attention to the non-current portion of liabilities, which basically include two parts, the equity part and the debt part or external liabilities part. Let's take that one by one. Let's start with the equity part. The share capital is the initial money put in by the promoters, right? So this one here is the equity part broadly. This here is the liability part. I'll talk about the other three in a minute, right? So the initial money, which is basically nothing but the face value of shares multiplied by number of shares. Usually this face value is either 10 rupees or 1 rupee or something of that sort. So practically this number that arises is going to be a factor of so for example, if the face value is 10 and this number is 971 crore, then the company has 97.141 crore shares. That's how you would find the number of shares typically. And this number is usually same for most companies that are there. 10, 1, some cases it is 5, some cases it is 2. But this is broadly the initial money that has been put into the company by the promoters or the owners of the company. Every year, the company keeps making profits. So retained profits, we've seen this, retained or undistributed profits become a part of reserves and surplus, which means since the time the company has started, the profits of 30,378 crore have not been distributed to the shareholders. They have been put back in. This is all reinvestment, correct? Over the years. Over the years. So let's say this year the company makes a profit of 1,000 crore. If they choose to pay some dividend to the investors, that goes out. If they choose to not pay any dividend, then that 1,000 will straight away come and get added here, right? On the cash side, on the asset side, that would come as cash. On the liability side, that would get added here on the reserves and surplus because that has been plowed back into the firm, correct? That's your reserves and surplus portion that you see there, right? We now move to the next three numbers, which is 2, 3, and 4. So you see number 2 is something called as a preference share. Now, in the context of money that company raises, there is equity, there is debt. Debt is fixed payment, but there is no upside sharing, right? No upside sharing in the sense that if the company does well, the payment is fixed. Equity is no fixed payment, but there is some upside, there is upside sharing that is there. Anything in between is possibly a hybrid kind of a security. So preference shares come somewhere here, where preference shares typically have a fixed dividend. They are equity shares, but they have a fixed dividend amount, right? There could be some other issues around it. There's some dividend that is there. Voting rights are higher or lower depending on that. But preference shares basically mean there is a fixed dividend, which is sort of an interest that is paid out, but they're like a share that is there, right? Hybrid securities are securities which are convertible, which means today they are debt, but tomorrow they can be converted into equity, right? So let's say there is a debt which says that you can, after 3 years, convert it into equity at the share price of 350 rupees per share, right? So effectively, when will you convert? It only makes sense to convert the debt to equity if the market price is above 350, right? Otherwise, you will keep it as debt, right? So if the market price is 550, you can immediately convert this debt into equity at 350, sell it in the market, and make the difference of 200 bucks. If the market price, on the other hand, is 250, there is no point converting into equity because you'll straight away see a hit of 100 rupees, right? So you'll keep it as debt. You'll keep getting your interest that comes. These are called convertible structures. These are typically called as hybrid structures, which have components of debt and equity put into them. In this particular case, we also see what is called as perpetual securities, which means they will always outstand. They will never close. Even if they are not converted, if they are converted, they will obviously become equity, which is kind of perpetual. But even if they're not converted to equity, they will always be outstanding. These are perpetuities, right? Something that we would probably read a little bit more about in financial management. These are called perpetuities. A lot of these complicated structures are available only with complicated balance sheets like Tata Steel, right? In a lot of the simpler companies, you will not even find these two headers. So the reason we took this particular balance sheet was that we get introduced to some of these terms. It is not necessary for us to know these terms at this stage. If we know, great, right? Then comes the next term, which is called as minority interest. Now, what is the minority interest, right? Remember we said about consolidation, and what were we consolidating? We were consolidating anything that has a greater than 50% stake. So if you have a 100% stake, that's fine. You straight away kind of add the statements. If there is a company where you have 80% stake, right? So let's say this company has an asset worth 1000 crore. Now the consolidation principles say add line wise, which means you just do A plus B, right? You don't do A plus, you should ideally be doing A plus 80% of B, but you don't do this. You just do this, A plus B, right? Which means on your asset side, you will add the entire 1000 crore of assets. On the fixed asset side, you would add the entire 1000 crore of the assets of this company in which you have 80% stake. But if you sell this asset, the entire 1000 crore is not yours. How do you show that you have a liability of that 20%? Your stake is only 80%, which means if you sell this asset, you are entitled to 800 and someone else is entitled to 200, right? This is a sort of a liability that you have, especially if you have accounted 1000 crore as asset on your fixed assets, correct? So if you sell this asset, you keep 800, the other 200 has to go out as liability. This is represented here as minority interest. This minority interest term that you see here is the value of the 20% stake that someone else has in this example, or 30% or whatever. If I have a stake of 60% in a company, the 40% value will appear here, because on the asset side, I would have just added it line by line and added the 100% value, right? Again, a slightly complicated concept. We don't necessarily need to kind of be very, very concerned about it at this point of time, but it's good to know what these terms are. In a lot of the firms where there is no subsidiary or no consolidation, you will not find this term minority interest either, right? Then we move to the next part, which is going to be your portions on the non-current liabilities, which, that we will look at the other non-current liabilities. So these other non-current liabilities include long-term borrowings from banks. Anything greater than 1 year from the bank is a non-current liability, long-term borrowing. Then you see deferred tax liabilities. These will come again due to accounting differences and income tax rate differences in terms of depreciation. So if you pay less tax today, then you will have a sort of a liability because you will have to pay a higher tax tomorrow, correct? You have two more terms called other long-term liabilities and long-term provisions. Let's take long-term provisions first. Long-term provisions could be, for example, you have some expense that has been accounted in the salary or in the P&L, but you have not paid it. Take salary income, for example. Salary is typically your base salary plus some sort of pension plan data, right? So you have a term called gratuity. What is gratuity? Gratuity is payable to someone after 5 years of service. Gratuity is payable after 5 years of service. So you will account it every year, but you will hold that money and you will pay that after 5 years, which means that's a long-term provision. If you're paying it in within 1 year, that's a short-term provision. But if you're going to pay after 5 years, you will find gratuity or pension clauses coming under long-term provisions for firms. A lot of the firms do this, that out of 100 rupees of salary, they take out maybe 2 rupees for pension and just hold it till the time you retire. So whenever you leave the company, you get this money. So that's accounted as long-term provision. Other long-term liabilities, let's say you rent out a building, right, for 5 years, and you take a deposit and take a rental deposit, which is, let's say, whatever, 1000 crore or 100 crore or something, and you are going to pay this back once you kind of end the lease agreement, right? That's what is called as a long-term liability. Anything that does not fall in the rest of the categories, that's a long-term liability. That's an example. If you have a deposit that you have taken but not paid out, that's a long-term liability that comes in there, right? These are other long-term liabilities that come in. Right, so just a quick recap around all of these. Current liabilities are liabilities that are expected to be settled in the entity's normal operating cycle, held for trading and due to be settled within 12 months. So typically your operating cycle, account payable are amounts that a business owes to its vendors for goods and services that has been purchased but not yet been paid. Short-term borrowings are owed to a business by a business to creditors as a result of borrowing due to a short-term agreement. Other current liabilities include things like customer advances or unearned revenues, right? So when we look at current liabilities, any kind of customer advances come in here as well. Correct. Short-term provisions are made for accrued liabilities, also known as accrued expenses. These are expenses that have been reported, but they have not been paid because there is no legal obligation to pay as on the balance sheet date, right? So accrued wages payable, any kind of bonus declared, right? That's all that is going to come. Dividend payable, any tax payable, any accrued interest payable, all of that will come as a lot of the short-term provisions that are going to be made, right? Then share capital is the initial amount of capital as invested by the shareholders. Reserves and surplus is any undistributed profits for the firm are plowed back in the form of source of funds. This is considered equity holders' money since it has to be returned, right? Preference shares are class of shares somewhere between equity and debt. They are usually like equity, but they have a fixed dividend, which is a component like debt. And other securities, you want to raise money other than debt, they could come in the form of hybrid securities, which are a combination of equities and debt. You could also see the term warrants, which can be converted into equity. Warrants or rights can be converted into equity at some point. So again, something that is a little bit too complicated for us to study at this point of time, but just probably known that we have read about this. So if we read this term somewhere, we get a sense that okay, yeah, we understand what this is, right? Then we talk about minority interest. If a company holds less than 100% in another entity, even then under consolidation principles, 100% of the assets are added up on the asset side. The part that is not owned by the company is put on the liability side as minority interest. We looked at the example of a company that has 1,000 crore asset in one of its subsidiaries where 80% ownership is there. So the remaining 20% is put as minority interest, because on the asset side you will show the entire 1,000 crore. On the liability side, minority interest will be 200 crore. So the net amount is 800, which is your value of the assets, right? Long-term borrowings, any borrowings that are taken for a term longer term from banks or any other lenders. Deferred tax liability, if you've paid lesser tax today than what is meant to be paid, then that's a deferred tax liability. Long-term provisions, any provisions made for payments which have been accounted for in the income statement but will be paid only in the long term. Gratuity is an example where the salary includes, or any kind of pension is an example where the salary includes this component, but you have not yet paid it because there is no legal liability to pay it at that point of time. And other long-term liabilities, any liability that does not fit into the above is classified here. So for example, we saw if a company has taken a rental deposit, right? They're supposed to pay it back, right? They could have taken a long-term customer advance, right? That will come here as well. So it depends on what kind of value you have, or what kind of term you have, what kind of liability you have, but it will get classified as other long-term liability if it is not getting classified anywhere else. So those are all the non-current liabilities that we see. So we've seen the current liabilities, we've seen the non-current liabilities. That is the crux of all the liabilities that are available on a company's balance sheet broadly. That brings us to an end of this particular video. Explain the following questions very quickly. Give two examples of current liabilities and explain what do you mean by reserves and surplus and how is that classified as a liability on the balance sheet, right?